In the 1970s, the world's most powerful governments confronted a frightening realization. Control was slipping. Inflation climbed. Unemployment climbed. Growth slowed. The trusted economic playbook, relied upon for decades, stopped delivering results. Policymakers had believed the economy could be managed like an aircraft panel. Increased spending and unemployment falls. Cool demand and inflation eases. It felt scientific, measurable, controllable. Then the gauges stopped responding. Welcome to the Financial Historian, where money, power, and history collide, and nothing is ever as simple as it looks. When the system faltered, one economist wasn't shocked. For years, he had warned that governments were playing a dangerous game, that inflation was not a harmless side effect, but a warning signal, that unemployment could not be permanently engineered lower, that fine-tuning a complex economy would eventually produce instability. His name was Milton Friedman, and whether one agrees with him or not, the financial architecture we operate within today still runs on principles he helped install. To understand why Friedman mattered, you have to see the world he was challenging. After the Great Depression of the 1930s, faith in free markets collapsed. Banks failed. In the United States, unemployment surged above 20%. Output cratered. The old laissez-faire belief that markets quickly self-correct looked naive, even cruel. Into that vacuum stepped John Maynard Keynes. Keynes argued that markets could become trapped in prolonged slumps. Demand could collapse and remain collapsed. In those moments, government spending wasn't distortion. It was rescue. Run deficits in downturns. Stimulate demand. Smooth the business cycle. After World War II, this framework became doctrine across the Western world. Governments would manage demand. Central banks would support growth. Fiscal and monetary policy would coordinate. Regulation would prevent another 1929. And for a time, it appeared to work. The 1950s and 1960s delivered strong growth across the United States and Western Europe. Wages rose. Industrial production expanded. The middle class grew. Inflation remained moderate. Unemployment stayed relatively low. It felt like a golden age of managed capitalism. Embedded in this consensus was a powerful concept known as the Phillips curve, an observed trade-off between inflation and unemployment. When unemployment was low, inflation tended to be higher. When unemployment was high, inflation tended to fall. The implication was intoxicating. If policymakers tolerated slightly higher inflation, they could keep unemployment permanently lower. It was a menu of options. Choose your preferred balance. The economy became something to optimize, and optimization is seductive. Nothing says we've mastered the system, like believing you can calibrate with small adjustments. But Friedman saw the flaw. In the late 1950s and 1960s, while consensus confidence was strong, he argued that the Phillips curve trade-off was only temporary. Workers and businesses would adapt their expectations. If policymakers push inflation higher to reduce unemployment, people would anticipate that inflation. Wages would rise. Prices would rise. The short-term employment boost would disappear. You cannot fool an economy indefinitely. He formalized this in what became known as the expectations-augmented Phillips curve. In simple terms, unemployment gravitates toward a natural rate determined by real structural forces, demographics, technology, labor market design. Attempts to push unemployment below that rate through monetary expansion would only produce accelerating inflation. It was a quiet revolution in thought, and it rested on a broader claim that defined Friedman's legacy. Inflation is always and everywhere a monetary phenomenon. Strip away the abstraction, and it means this. Sustained inflation occurs when the money supply grows faster than the economy's capacity to produce goods and services. Too much money chasing too few goods. Not corporate greed. Not unions. Not mysterious forces. Money growth. In the 1960s, this view was not dominant. Policymakers emphasized demand management and fiscal stimulus. Monetary policy was reactive, often shaped by political pressure. Money supply growth fluctuated. Friedman believed discretion was the core problem. Instability, he argued, was not a failure of markets, but a failure of policy. Governments oversteered. They reacted late. They overcorrected. Liquidity was injected when politically convenient and withdrawn when inflation became uncomfortable. Instead of discretionary tinkering, Friedman advocated rules. Central banks, he proposed, should follow a predictable path for money supply growth. No improvisation, no political manipulation, stability through constraint. Markets, in his view, were coordination systems. Millions of decentralized decisions, guided by price signals, allocate resources more efficiently than centralized planning. Government intervention, unless tightly limited, distorts those signals and generates unintended consequences. This was not moral preaching. It was about incentives. Bureaucrats respond to political incentives. Markets respond to price incentives. One adjusts through elections, the other through profit and loss. The distinction matters. Throughout the 1960s, Friedman's warnings were intellectually provocative but politically marginal. The post-war order seemed stable. Inflation was manageable. Growth was solid. The Keynesian consensus dominated universities and government offices. Then the 1970s arrived. In 1973, the first oil shock followed the Arab-Israeli War. Oil prices surged. Energy costs rippled across industrial economies. Inflation accelerated. Growth slowed. Unemployment rose. It happened again in 1979. By 1980, U.S. inflation exceeded 13%. At the same time, unemployment climbed and growth stagnated. A new word entered the vocabulary: stagflation. Stagnation plus inflation. Under the traditional Phillips curve logic, this combination should not have occurred. Inflation and unemployment were expected to move in opposite directions. Instead, they rose together. Policymakers had tried to maintain low unemployment through expansionary policies in the late 1960s and early 1970s. The outcome, Friedman argued, was predictable. Inflation expectations adjusted. Wage demands incorporated anticipated price increases. Businesses raised prices to protect margins. The employment gains vanished, but inflation persisted. The machine wasn't broken. The model was. This was Friedman's moment. In 1979, Paul Volcker became chairman of the Federal Reserve. Convinced inflation was fundamentally monetary, Volcker changed course. The Fed sharply tightened monetary policy. The federal funds rate eventually approached 20%. The consequences were severe: a deep recession, rising unemployment, business failures, farmers protesting high interest rates, political pressure at intense levels. But inflation collapsed. From above 13% in 1980, U.S. inflation fell dramatically over the following years. By the mid-1980s, it was under control. The cost was painful. The message was clear. Monetary discipline worked, at least in restraining inflation. Friedman's ideas moved from academic debate into the core of policy thinking. Monetarism, the focus on controlling money supply growth, reshaped central banking philosophy. This was more than technical adjustment. It was a shift in intellectual gravity. If inflation is primarily monetary, governments cannot engineer lasting prosperity through demand manipulation. If unemployment gravitates toward a natural rate, activism has limits. If markets coordinate better than bureaucracies, intervention should be exceptional, not routine. The burden of proof shifted. Before Friedman, intervention was assumed wise and markets suspect. After Friedman, markets became the baseline, and intervention required justification. The transformation did not stop in the 1970s. It accelerated. In the United States, Ronald Reagan entered office in 1981 promising tax cuts, a smaller government footprint, and expanded private enterprise. In the United Kingdom, Margaret Thatcher pursued deregulation, privatization of state industries, and labor market reform. Their rhetoric was not identical to Friedman's academic writing, but the intellectual climate had changed. Government intervention was no longer automatically presumed wise. Markets were no longer presumed fragile. They were presumed capable. And this is where the phrase trickle-down economics enters the conversation. Trickle-down economics was not a phrase Milton Friedman invented, nor was it a formal model in his research. It emerged later, often from critics, as shorthand for supply-side tax policy. Reduce taxes at the top ease regulation, and allow investment to expand the economic pie. The logic was simple. Lower marginal tax rates increase incentives to work, invest, and take risks. Businesses retain more capital. Investment rises. Growth accelerates. Over time, the benefits spread through jobs and wages. In the early 1980s, the top marginal federal income tax rate in the United States fell from 70% to 28% across the decade. Capital gains taxes were reduced. Corporate tax structures shifted. Financial markets were liberalized. Growth did return after the early 1980s recession. Inflation stabilized. Productivity improved later in the decade. The U.S. economy expanded strongly during parts of the 1980s and 1990s. But something else unfolded at the same time. Asset ownership became increasingly central to wealth accumulation. Capital markets deepened. Financialization accelerated. Globalization expanded supply chains and capital mobility. Union membership declined. Labor's bargaining power weakened relative to capital. Growth occurred. Distribution shifted. And this is where nuance matters. Friedman argued that markets allocate resources efficiently. He did not argue that markets distribute income equally. Efficiency and equity are not the same outcome. Markets respond to incentives, information, and ownership structures. If capital ownership is concentrated, gains concentrate. That is not a moral claim. It is structural arithmetic. From the 1980s onward, stock market participation expanded, but ownership remained uneven. Housing appreciation boosted middle-class balance sheets in many countries, yet equities and financial assets rose even faster. Corporate profits as a share of GDP increased across several advanced economies. Executive compensation surged relative to median wages. Meanwhile, inflation remained relatively subdued for decades. Central banks gained credibility. The fear of runaway price spirals faded. Friedman's core victory, anchoring inflation expectations, reshaped central banking globally. Monetary policy became more rule-oriented and more focused on price stability. Independent central banks became the norm. Controlling inflation turned into a primary mandate. In that sense, his influence delivered stability. But stability in prices does not guarantee stability in distribution. As financial markets expanded in size and influence, capital became increasingly mobile across borders. Firms optimized globally. Production shifted. Supply chains stretched. Shareholder value became a dominant metric. Markets were no longer just tools within the system. They became the system's organizing principle. This is where the phrase "made markets a religion" gains its edge, not as accusation, but as observation. A religion is not merely belief. It is a hierarchy of assumptions. It defines what is taken for granted. After the 1980s, the default assumption across much of the Western world was that markets allocate better than governments. When crises emerged, the instinct was often to repair markets, not replace them. Even the financial crisis of 2008, triggered by excess leverage and regulatory blind spots, did not dismantle the market framework. Governments intervened massively. Central banks expanded balance sheets by trillions. Interest rates fell toward zero. Liquidity facilities stabilized banks. But the objective was restoration. Restore market functioning, not abandon it. In the wake of the 2020 pandemic, balance sheets expanded even further. Fiscal stimulus surged. Asset prices climbed. By the mid-2020s, global stock market capitalization reached record levels. The number of millionaires worldwide rose to historic highs, driven largely by financial and real estate appreciation. More wealth existed than ever before. At the same time, wealth concentration widened in many advanced economies. The top segments captured disproportionate gains from asset inflation. Wage growth for many workers lagged behind capital appreciation. Housing affordability deteriorated in major cities. Markets optimized. They did not equalize. Here is the structural distinction. Markets are powerful coordination engines. They process information rapidly. They reward efficiency. They punish misallocation. But they do not contain an internal mechanism that guarantees broad distribution of gains, unless ownership of productive assets is already broad. Self-regulating suggests markets correct toward stability. Self-optimizing means a drive toward efficiency and scale, even if scale concentrates power. These are not the same. When competition is vibrant and barriers to entry are low, markets diffuse opportunity. When scale advantages and network effects dominate, markets consolidate. The digital economy intensified this dynamic. Platform companies leverage global scale. Marginal costs for digital goods approach zero. Network effects entrench dominant players. Market capitalization concentrated. Nothing in Friedman's central thesis promised equal dispersion of gains. His argument focused on efficiency, inflation control, and limiting discretionary intervention. The structural consequence was that market outcomes became more politically difficult to challenge. If markets are assumed optimal allocators, redistribution demands stronger justification. If government is presumed distortionary, intervention becomes suspect. The burden of proof had shifted. This does not mean Friedman caused inequality. It means the intellectual framework that prioritized market allocation reduced the default appetite for corrective intervention. And yet reality complicates every clean theory. When crises erupt, markets alone do not absorb the shock. In 2008, governments injected capital into banks. Central banks purchased assets. During the pandemic, fiscal transfer supported households and firms directly. Markets remain dominant, but they are not solitary. Even today, policymakers oscillate between deference to markets and strategic intervention. Industrial policy debates reemerge. Antitrust scrutiny intensifies. Regulation of technology platforms becomes more contested. Inflation periodically resurfaces, reminding central banks that discipline still matters. Friedman's framework remains embedded in central banking orthodoxy. Inflation targeting, credibility, and expectations management are foundational. But the political environment surrounding markets has grown more contested. In 2026, the world contains more millionaires than at any point in history. Financial assets have multiplied. Global capital flows remain vast. Simultaneously, debates over inequality, housing costs, labor power, and corporate concentration intensify. Did markets succeed in controlling inflation over the long run? Largely, yes. In generating growth and innovation, undeniably. In distributing gains evenly, not automatically. Friedman did not argue that markets create fairness. He argued they create efficiency and freedom of choice within a price system. Whether that freedom translates into broad prosperity depends on surrounding institutions. Taxation, competition policy, education systems, asset ownership structures. The modern financial system still operates within the intellectual architecture he helped construct. Central banks guard inflation expectations carefully. Fiscal authorities face skepticism about discretionary fine-tuning. Markets remain the default coordination mechanism. But default does not mean divine. Ideas evolve. Context shifts. Institutions adapt. Milton Friedman did not make markets powerful. Markets were always powerful. He made them the baseline assumption. And when an assumption becomes baseline, it shapes everything that follows, from tax policy to central banking to debates about inequality. History does not deliver final verdicts. It reveals consequences. Friedman's legacy is not a slogan. It is an operating system. It stabilized inflation. It empowered markets. It constrained governments. It amplified capital mobility. It reshaped the relationship between money and power. Whether that system produces broadly shared prosperity or concentrated wealth depends on forces beyond any single economist's thesis. But ignoring the architecture would be a financial mistake, because once an idea becomes doctrine, it stops feeling like an idea at all. It feels like reality. If this gave you a new perspective, subscribe. History has the answers. I'll show you where to look.